But the fact of the matter is that the Dow lost something like 89% of its value from September 1929 to the middle of 1932, and 9,000 banks went bust on the back of it. This time, the bubble is a lot bigger. It's a record in real terms. And not only that, but if you look at the Smoot-Hawley Mark II, or Trump's tariffs, the US involvement with international trade is far greater. And not only that, but you've got supply chains, which is something that didn't exist in the 1920s. This is really a lot more serious this time. So the idea, I mean, I think that the model, if you like, the 1929 to 1932 model, has the potential to be a minimum expectation of what we see ahead of us.
You're watching Capital Cause, and my name is Danny. And today's guest is Alasdair Macleod from Macleod Finance. Alasdair, thank you so much for coming on the show, my friend.
That's my pleasure.
Yeah, let's just dive right in, Alasdair. So many things ongoing right now. Obviously, we have the trade war. We're in the middle of a pause. But now we've been seeing this gold price rally up. It is April 16th at the time of this recording, and we're looking at a $3,341 gold price, at least on the June contract. I believe you said it was 33.20 some odd change over there on the spot market. But nonetheless, we have broken through this $3,300 handle. Silver's at $32.92. It's right at the cusp of a $33 handle. You do have this gold to silver ratio of about 100 to 1, which is very few times in history where it's hit that level. So, are we about to see a mean reversion to where silver begins to outperform gold? Is gold about to come back and crack down and revert that mean somewhere? Where do you make of all of this? Let's start off with the gold price.
Okay.
What's going on with the gold price?
Yeah, I mean, there's every reason to buy it, is a short answer, really, because people, I think, particularly abroad, by abroad, I mean outside America, and particularly in Asia, are realizing to get out of Western currencies, get out of credit. And then what do? They all know that real money is gold and silver. I mean, they're not buying silver. Silver isn't being priced as money at all. We can come on to that in a moment. But, I mean, really led by the central banks, sovereign wealth funds, I guess, some of the very, very wealthy billionaires in Asia, of which there are increasing numbers, they're buying gold. And not only that, but I mean, we had the story about 3 weeks ago about how insurance companies were being given the green light to do a pilot project of putting up to 5% of their assets into gold, physical gold. And we were looking at something like, I mean, this was just restricted to about half a dozen insurance companies. And that was, sort of 300 tons or something. And that really did seem to get things going. That is going to, I guess, be expanded because if you're in China, the only decent performing asset is gold. So where do you go? Why am I restricted? Why am I not allowed to buy it? And as to another point, the Chinese housewives are avid savers. They save something like $2 to $3 trillion equivalent a year. And of course, property's bitten the dust now. Stock market is uncertain as far as they're concerned. They've only got bank deposits, and the rates have been cut recently, or gold. And most banks offer a gold account. So I think we're seeing quite a lot of that savings, if you like, going into gold accounts. I mean, it just makes so much sense. As soon as you understand that gold is money and the rest is credit, which I think increasingly these Chinese people do, then, you tell your bank, please open a gold account. Here's my initial deposit of 500 yuan or whatever it is. And I'd like to add to it with 100 yuan every month. And you've got millions and millions of people doing this. So I think that's really what's accentuating the shortage of bullion in the West. And then there is another factor, of course, for whatever reason, and we can go into that in a bit maybe, but for whatever reason, gold has been arbitraged into the Comex warehouses from virtually everywhere else. So there is no liquidity in London. There's none in Switzerland. There's none in other centres either, really. I mean, even Mumbai, or Bombay, as I was about to call it, even Mumbai has sent gold over to benefit from the arbitrage. I mean, they're getting something like $50 an ounce on that. That, I think, is, I mean, looking at the Comex warehouse figures, I think that's now appalling. But there was an interesting factor in this, and that was that the queue of people or institutions, businesses, trying to take gold out of the Bank of England. Now, the Bank of England doesn't actually store very much gold for commercial entities. It predominantly stores it for central banks. So we don't know for certain, but I feel pretty sure that much of the gold that was taken out of the Bank of England and is still being taken out of the Bank of England is actually leased gold. Now, I don't think that's the deal which the lessors actually anticipated, because really, I think for the last 20 odd years, maybe longer, the Bank of England has run something they call a book entry transfer system. In other words, they will run books to show the actual ownership of gold. So if you're a central bank and you lease your gold, the ownership changes. It's actually as simple as that. You don't have any right over that gold until the lease expires.
So, now, just really quick, so was the Bank of England the leaseor in this instance?
No. It's just an agent.
Okay.
It's just acting as the agent. Okay. But the point is that gold leasing has provided the liquidity in the London market. And been a central part of the liquidity, and also has been part of the liquidity which the Bank of International Settlements uses as well. So you've got these sort of powerful forces which have kept some sort of order in the market, if you like, in London and also Switzerland. And it's relied on the liquidity from leasing. Now, we see central banks accumulating gold like 1,000 tons every year for the last 4 years, and I guess that they're placing an even greater urgency on accumulating it. It makes no sense for anyone in the central bank cohort to lease their gold. So I guess that as these leases fall due, they're not being renewed. The effect actually could be systemic, because this gold, it's leased, let us say, for a year or two to a commercial entity, a bullion bank, say, and then it rehypothecates that probably to someone else, and it may be rehypothecated to another somewhere else. So you could probably have 4, 5, 6, 10 owners, essentially, of a particular piece of bullion. So you can see how important it is to the overall liquidity of the market because of the way in which this leasing works. So if that is coming to an end, then there is a crisis developing in the market. That is the point. I suspect also that the central banks see this, and many of the central banks, and remember, the central banks do talk to each other. And they have a bi-monthly meeting under Chatham House rules at the Bank of International Settlements in Basel. So they talk to each other. They know each other. So, they know why other banks are buying gold, even if they're not. And if they're not, it's because of policy rather than, sort of, if you like, apathy or some sort of belief that we shouldn't be doing this. So I think this central bank story is going to tighten and tighten and tighten on the market. It's just really going to squeeze it. And interestingly, I mean, we've had some days when we have seen the gold price rise very, very sharply, with open interest on Comex actually contracting. It's not the hedge funds who've been buying it. I mean, yes, they're in there to an extent, but basically, it's the system which is in the squeeze, which is interesting. Now, I think you could probably divide the bullion bank community into two camps. You've got the big boys, who I think have probably got bullion. They've got some liquidity. And I think this is why they feel quite relaxed talking about, we expect gold to go to 3,500 or 4,000 if following happens, whatever. So they're quite happy to talk it up because they've got a bit of stock on board. But I don't think that's the case with most of the smaller traders, bullion bank trading desks in the market. And they could be getting into some serious difficulties on this. So I think that's where we are with gold. And the important point is that the people who are buying it actually realize that it's not gold going up, but it's the dollar going down, or the euro going down, or sterling, or whatever your currency is. That is the important point. The people who are last to understand this are the users of an actual currency. So in the case of the dollar, the last people to understand this are its users. Second to last are the institutions that manage the users' savings, capital, wealth, whatever. They've been out of it for so long. And of course, the other thing is that the brokers they don't cover the sector really. I mean, gold coverage. I mean, for a start, they don't understand economics. They understand macroeconomics, but that's a non-science. They don't understand money, credit, relationships, etc. Most of them don't even understand how banks create credit. I think that they're going to be gradually waking up to the fact that they're missing out on a story here. They won't know why they're buying it, but they're coming under pressure to buy it, because the best performing asset in first quarter 2025, without a doubt, was gold and gold-related investments. So we're beginning to see that shift. And if you look at the most recent figures for global ETFs, which were March, released by the World Gold Council last week, I think, that they're beginning to buy the ETFs. The amount of ETFs were increased, if you like, outstanding increased by a net 90 tons. Doesn't sound a lot. Maybe not a lot, but we're only talking about 1 month, and that's going to put added pressure, I think, on the market. So I think that's roughly where we are. I think anyone with any sense doesn't really try and trade it. I mean, I could see how it was going to open this week weaker. Because of the news announcements in China, and I don't know, I can't remember quite what it was, but it had run up very, very strongly. And I thought, okay, right, it should really come back. Yeah, it did, but for about 5 minutes. If I traded it, I would have had egg on my face. I mean, it's quite simple. The answer is don't trade it. The answer is stack. Just stack, 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 because what you're doing is getting the hell out of credit. That's the point.
Yeah, don't get too cute with this stuff. It's very simple.
Absolutely. Absolutely.
Yeah, I want to harp on the rehypothecation aspect you mentioned. When you have multiple claims to the same unit of gold, and if this begins to unwind, who gets the gold in the end? If there's like 5 entities who claim the same unit, who ends up getting the gold in this case? Just out of curiosity.
Well, one of the problems is that if it disappears out of the Bank of England vault, we don't know.
Okay.
And of course, it's compounded a bit because, if you've been the mug of a central bank to try and earn a few pennies to pay for the Bank of England's storage fees, are you going to admit that you did it? No, you're going to keep very, very quiet. So we will never know.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
Why are we also seeing this record
flow into the Comex too. What's the deal with gold coming into New York? We've covered the London side. What about the New York side?
Yeah, I think that's fascinating. I don't think anybody's really come up with a sensible answer, and to some extent, it's a bit of a guesswork, but hopefully educated guesswork. The way I see it is that there have been stands for delivery which have ended up spending an inordinate amount of time sitting in Comex warehouses. This has been the past. So the point about stands for delivery is as they go out of the warehouses, then this is definitely a drain on liquidity in Comex. We had Trump saying from the outset, 25% tariffs across the board. So immediately there was a panic because there stands for delivery that have yet to be delivered. And you had, if you like, the system had to cover itself so that it could meet those. It couldn't sort of just bluff its way out anymore. Suddenly it had a 25% increase in the price of gold potentially just from tariffs, and it had commitments, down at the international level. So that I think was the trigger for it in a sense. But what has happened also is that with Trump's economic and tariff policies, the rate of stands for delivery has increased very, very sharply. To give you an idea, over the last 4 years, on my figures, stands for delivery have been around about 2,100 tons. So for the whole of the last 4 years. Since the beginning of this year, the rate of stands for delivery, if it continues at the current level, are running at around about 1,700 to 2,000 tons this year alone. So it has increased very, very substantially. We don't know who's standing for delivery. My guess is that it's central banks, again, using this, not the big ones, but the minor ones, probably sovereign wealth funds, that sort of. I mean, there was one day when the stands for delivery were 109 tons, 108 tons, I think it was. And that's $10 billion. Who's got that sort of money to throw around? It's not the business of hedge funds or banks to do that, really. Well, right. I mean, a bank can do it. But banks are in the business of dealing in credit, not dealing in physical, which is why they're always reluctant to deliver physical, which is, because they tend not to have it. They give you a promise, and you can trust their promise if you wish. But the idea of actually storing huge amounts of gold on balance sheet is an anathema to a banker. It's not a sensible use of resources. Having said that, of course, there are changes coming in with Basel III, which I understand from the middle of this year means that gold will be treated as as the most liquid asset, no haircut, whatever, assuming you've got it. Well, you've got it vaulted in somewhere under your control, earmarked for you. So things are changing a little bit on that, but I don't think enough to persuade a bank to get into the, the gold storage, gold ownership business. No, I mean, they're dealers in credit. That's really what they do, which is why, of course, the credit markets are so highly leveraged. Nobody really wants to have the physical stuff. We'd far rather write, write obligations and receive credit, or persuade people to receive credit instead of the hard stuff.
Has gold become the safe haven trade effectively, especially after what we've seen last week? Last week defied all conventional norms. And what I mean by that is that when you do see these big market corrections and these crashes, you have a capital rotation event from stocks into bonds. That did not happen last week. The DXY, the US dollar, also went down last week. But what didn't go down as much as everything else was gold. Was this kind of like a wake-up call for the financial and investing community, so as to say that it's not the US dollars, it's not even US treasuries, but it's gold that you need to be in if you're looking for that safe haven trade away from stocks and risk assets?
Well, broadly, yes, but it's slightly more complicated than that. I think the portfolio shift adjustment. I'm sure some of that was in there, but it was swamped, if you like, by other factors. And I think that's going to be a feature, if you like, over the next few months, because I have no doubt that the greatest credit risk there is actually is in the credit bubble popping and the effect on equity values, equity share, stock prices. So you're going to get a lot of readjustment, I think, to try and ensure that, fund manager can tell his, the underlying beneficiaries of a portfolio that, the S&P was down 20%, but don't worry, your portfolio is only down 15%. Haven't I done a good job? You know the story.
Yep.
But actually, I think what was happening, it was interesting because you had this very sharp swing up in the Treasury yields and a sharp move down in the dollars trade weighted. And what that was about, quite simply, was foreigners getting out of treasuries and also the dollar. I mean, if you're going to sell treasuries, you're going to sell the dollars as well. I mean, why did you? Unless you're entirely confident in Mr. Trump and his wonderful policies, and it's all going to come right in the end. In which way, probably what you do is you might sell your long-dated treasury notes and get into, say, T-bills or something. But basically, I mean, the other factor is that with the world now very definitely being driven into recession, slump, even, on that basis, do you really need to have so many dollars in your back pocket so that you can trade internationally? No.
Right.
So that's I think, going to be quite a source of selling. The other thing is that as the equity market falls further, there is at the moment, on a valuation basis, some $14.5 trillion worth of foreign investment holdings in US equities. Are they going to hang around and watch those values disintegrate? I don't think so. So you've got potentially some huge selling, and it could come in a rush. It's not looking all that good, really.
Some huge selling in the equity market?
Yeah.
You think it's going to continue?
Foreign interests own, according to, this is US Treasury tick figures, $14.5 trillion worth of equities, US equities. And I mean, why are they there? They're there because they think they can. I mean, okay, we can talk fancy diversification, or that's a load of rubbish, really. At the end of the day, the reason you own shares in a foreign market is because you think the damn things are going to go up. I mean, right. Let's cut to the chase. That's what you do. And as soon as you realize they're not going to go up, what do? You get the hell out. And they could be doing it all at the same time when it happens. They haven't started yet, I don't think. But, any technical analyst will tell you that, the S&P has now completed a death cross, and it looks actually bloody awful. So, the message, I think, is, will begin percolating through very soon.
And how bad do you anticipate it getting?
Sorry, how bad is what getting?
The market sell-off.
Well, I think it's only just started. I mean, you've got two things, Danny, which are working against markets. The first is the biggest credit bubble in history. And anyone who doesn't understand a credit bubble, I'm sure they understand a debt bubble. The credit bubble is the other side of the debt bubble. For every debt, there is a credit. Just look at the amount of debt. I mean, government debt, and also zombie corporations and all the rest of it. We can see that prick that bubble, and these bubbles just do get pricked. It's as simple as that. Then this is going to be disastrous. And then on top of that, you have Trump mucking around with tariffs, which is exactly what happened in 1929, because you had the end of the Roaring Twenties, credit bubble, with Smoot-Hawley Tariff Act, which came in, and the combination of those two things, I mean, you can blame one more than the other, whatever, it doesn't really matter. But the fact of the matter is that the Dow lost something like 89% of its value from September 1929 to the middle of 1932, and 9,000 banks went bust on the back of it. This time, the bubble is a lot bigger. It's a record in real terms. And not only that, but if you look at the Smoot-Hawley Mark II, or Trump's tariffs, the US involvement with international trade is far greater. And not only that, but you've got supply chains, which is something that didn't exist in the 1920s. This is really a lot more serious this time. So the idea, I mean, I think that the model, if you like, the 1929 to 1932 model, has the potential to be a minimum expectation of what we see ahead of us.
And what do you make of this current trade war? We just saw Trump raise the tariffs on China to 245% this morning. And we've also seen him say things along the lines of throwing an ultimatum to the rest of the world, saying that if you cut off ties with China, we'll reduce your tariffs. Where is this eventually leading to, in your view?
Well, I mean, that is just plainly ridiculous. I mean, first of all, he's just shutting down trade with China. Does China care? Well, yeah, a bit. But it's been preparing for this, really, for the last 10 years, maybe even longer. So its dependency on America has actually reduced hugely. It'll cause a few aches and pains in China. Let's not ignore that. But this isn't going to be a death blow to China by any means. It's more of a death blow, actually, to America. The complications in this are that virtually every manufactured product, which is complex, has input from China. So even if it's made in Mexico or Vietnam or Thailand or even in Europe, some of those components are Chinese. So it's going to be interesting to see how Trump deals with that one. If he deals with it on the basis that, the Chinese components have got a 245% tariff on it, I mean, this is just going to be ridiculous. And what he's actually doing is he is driving countries away from America. Not just out of US treasuries, but out of America and the dollar as a whole. I mean, this is actually very, very silly on any level. Downright stupid, really. I mean, it's interesting because it's so dumb that so many people I talk to think there's an ulterior plan in the background. There has to be, because this is too dumb. But I'm sorry, I'm the world's worst cynic. I've seen lots of politicians. I've met a lot over the years. My uncle actually was Chancellor of the Exchequer in the UK back in 1970, briefly before he died in office. So I met all these guys. They're not that clever. They really are not. They've got some pretty good civil servants behind them, maybe in the permanent establishment, but but basically they're a bunch of idiots. They don't know what they're doing. They rely on advice, but basically they will come up with a wonderful policy which satisfies their voters or a particular pressure group. They feel, right, that's great. We're doing our job. We're looking after these guys and all the rest of it. But then when you get the unintended consequences, then they learn. And it's only then they learn. And they don't know what to do about it when they do learn. Nobody in Trump's entourage actually realizes the relationship between credit bubbles, and tariffs, and the outcome in 1929. And I think if I told them, they'd say, "Well, oh no, that's history. It was all different then. It's different." They don't want to listen. They don't. They're dumb. I mean, there's no further explanation required. These guys haven't got some wonderful agenda in the background, which they're keeping very, very secret. No, they're just a bunch of idiots, not knowing what they're doing.
So am I accurate in saying that tariffs are actually deflationary as opposed to the conventional form of thinking that they are inflationary in this regard?
They're economically destructive. Basically.
Right.
I mean, when combined, sometimes they're not. Every president, I was talking to Steve Hanke not so long ago about this. I think he advised Reagan, and he was saying that every president since Reagan has basically introduced more tariffs one way or the other. Now, so what Trump is doing is he's actually just doing it a bit more aggressively. But it's the credit bubble, which I think is the combination of that with a credit bubble. I mean, we got the credit bubble as it is. This is something which people just don't understand. They've got to understand. What makes a stock price? The amount of credit that is available to puff it up. That's the key point. If credit starts deflating, it doesn't matter how good a company is, the stocks are going down. That is the reality of it. And then, of course, you get the consequences of that because stocks are collateral. I mean, we got margin accounts which total, according to FINRA, something like $900 billion worth at the moment. And of course, the banks take this in as collateral for other loans and so on and so forth. And what happened in the 1920s, as the stock market slid, particularly between 1930 and 1932, banks were forced to sell out collateral because they no longer covered the loans. And, it was just an unremitting thing. Irving Fisher was the guy who actually sort of noticed this and made it a sort of, if you like, made the economic community aware of this relationship between collateral having to be sold in a downward market, just making things far worse. It's going to happen again.
Interesting. Quick side note on the currencies the currency movement that we saw last week as well was that we saw the euro get a bid, we saw the Japanese yen get a bid in the context of the dollar coming down. What was the rationale behind that?
Just get the hell out of the dollar. It's as simple as that. I believe it or not, nobody's mentioned this, but the ruble has taken off. I don't know whether you've noticed it.
Oh, interesting. No, I haven't actually.
I think it's about 80 now, having been about 100 and something. The ruble is the best performing currency this year so far. Have a look at it.
Oh, yeah, it is. Wow. It is up 30 some odd percent.
Yeah.
Since the beginning of the year.
Mind you, I mean, there is the special factor that, Trump gets elected. He says, I can deal with the Ukraine position in one day.
24 hours.
And I'm going to talk to Putin, and we're going to deal with this. So you can see that, but also the ruble is a pretty thin market, so I wouldn't hang your hat too much on it. But I mean, basically, as far as owners of credit are concerned, currencies, foreign currencies, this is a race to the bottom. And, Steve Hanke says, the dollar is the least dirty shirt in the laundry. But, there are times when this dirty shirt gets really very, very badly stained. And of course, you get out of that and into something else. And that's basically what happened. I mean, they should be going into gold, but there's no gold available. That's the first problem. And secondly, they don't really understand. I mean, we've had, in Western capital markets, we've had gold drummed out of us. It's no longer part of the financial system. It's a pet rock. Who cares? Why buy gold? Don't be ridiculous. If you want to have a substitute, go and buy Bitcoin. We're all a bit confused over this.
And that's a great point, because gold's at 3,300 and you're not hearing a peep from it in the mainstream media.
No, I know.
Any other asset that would be hitting all-time highs the way gold is would be, it would elicit a mania, but it's the polar opposite with gold.
Yeah, it's fascinating, actually, Danny, because, it's classic market. Basically, gold has been going up. Everybody's been ignoring it because the buyers have not been in Western capital markets. They've actually been in Asian markets and central banks and whatever. So it goes up, and then it starts going into new high ground. And then people begin to think, oh, gold's going up. I wonder what's going on. They don't really know. They don't get a proper explanation from most sources. They come to my Substack. They might get a proper explanation if they can understand it. Really from there, they begin to get bullish, not because they understand what's going on, but because it's rising. How do you make money? You buy things that are rising. Don't ask questions. It's going up, so buy it. So I think that's beginning to happen. And this is why we're seeing money going into ETFs again. That's I think I said earlier, 90 tons in March alone in global ETFs. Not a lot, but I mean, this is enough to put an additional strain on the market. And I think the other thing which is interesting, and this, I don't give investment advice, but I think this is something which everybody should note. When you get a situation like this, something like gold has run away, and you don't actually understand why, but you think, only 2 weeks ago, this was 3,100 and it's now 3,300. I think I missed it. So how do I play it? Silver.
Yeah.
That is the cheap way in. And that's what's going to happen. People are going to buy silver. And, silver sort of came back. I mean, it was easy for the futures market to bash it, to try and square their books. Because the people who are in there, actually, I don't think were long of it on monetary considerations. I think they were long of it on industrial considerations. I mean, they know that as far as the Silver Institute is concerned, there's been a supply deficit for the last 6 years. Surely, with all the money that's going into photovoltaics and all the rest of it and the production, this shortage is going to get worse. Right, okay, we'll go and buy the future. We'll go and buy all options in a, sort of distant contract. So they were easily shaken out. And you could see, actually, it was a typical bull market pattern. When the price rises, open interest rises. When the price falls, open interest falls. It was absolutely classic. So that's fine. But now we have a situation where actually silver has just got itself so cheap because it's been shaken out that it's got left behind. And the 100-to-1 silver gold ratio says it all. Gold silver ratio, silver gold ratio says it all. So I think that would be my hot tip, if you like. The other thing is, of course, the mining sector has been left way, 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 way behind. And there's going to be a lot of money to be made if you know what you're doing in that sector.
Yeah, I'm pulling up the gold. I'm pulling up actually the silver to gold ratio here. Let me show you what I'm seeing. So here is the silver to gold ratio, not the gold to silver ratio. And you can kind of, you clearly see this goes all the way back to the 70s.
Yep.
And we've pretty much made a base here.
Yep.
This is the level we're at, 0.01. We crossed below it back in the COVID crash, but that was the exception. That was pretty much it. I mean, we haven't really, and that was that was an outlier event if there ever was one. So there you go. Much to your point.
An immensely bullish chart, I would say.
Mm-hmm.
And I mean, I can see silver running quite quickly through the 35, which has been, a little bit of a short-term cap on it. I can see it running up to $50 quite quickly. I really can. I wouldn't be surprised.
Yeah, and a retracement back to, I'm just going to eyeball it. I don't know what the actual average is. Let's go ahead and put in the moving averages. Yeah, I mean, a retracement back to the 200-day would be somewhere along the lines of what? A 40% move up in the price of silver? 50% move up?
Yeah.
So that's just getting back to the 200-day. So
but both the sort of 50-day and the 200-day moving averages are actually in bullish sequence. But I mean, they just bang the price below those moving averages, which, obviously you'd like to see it go above the moving averages. But I mean, the point is they're moving in bullish formation. So assuming that the price, and I think the price today is actually above that now. So it should be off to the races, I would say.
Think so?
Could be.
Yeah. Well, that's all I got today, Alasdair. Anything else you want to talk about that we didn't get into before we sign off?
Well, I would like the world to begin to understand what the hell is going on between money and credit. And in order to do that, the world should sign up to our 2 Substacks.
I'm not going to argue with you on that one.
So, no, seriously, anyone who doesn't educate themselves in this is likely to lose everything. I mean, it is that serious. This is why I make the point about 1929. This is worse than 1929. Bigger credit bubble, worse tariff situation.
Yeah, recipe for disaster.
Yeah.
And I also say a population less equipped to deal with the conditions of a 1929 or a 1929-esque scenario too.
Yeah,
a lot more self-reliant back then.
Yeah, of course, the other difference is that in 1929 we were on a gold standard, $20.67 to the ounce. This time, no gold standard. That means nothing to stop the dollar going down to zero.
Yeah, great point. Well, hey, Alasdair, for people who want to hear and see more, obviously they can check you out on your Substack. Link is down below, right below your name tag there. But anything else you want to plug?
No, I think that's it. I mean, I'm not in the business of plugging investments or anything like that. I'm just trying to educate people. So come to my Substack and be educated, please. It'll do you good.
We'll have the links to both of our Substacks, but check out Alasdair Macleod's Substack. Link to that is down below. Great wealth of information. And also, if you got value out of this episode, drop us a like and drop us a comment. Let us know what you thought. If you agreed with Alasdair, write "Go Alasdair, go" in the comment section. If you disagreed, that's fine too. Let me know why. I do read the comments. So let me know your thoughts. Subscribe to the channel to help us out in the algorithm. It does really go a long way in boosting this channel's reach and this video's reach. So if you'd like to support me continuing my work, an easy like, subscribe, and comment does go pretty deep. And then finally, check me out on Substack, capitalcosm.substack.com for early access, ad-free versions, and uncensored versions of all of my videos, especially for the ones that warrant it. And then check out our good partners over at Pimbex, PIMBEX.com for all of your gold and silver stacking needs. All right, guys, thanks for watching. I'll catch you in the next episode.